With the U.S. payroll report looming on Friday, the American jobs market is taking center stage, and it did not start out well. ADP missed twice with a downward revision to prior months, plus the lowest private payroll gain in 2 years for the month of May. It was so bad that President Trump lashed out at Fed Chair Jay Powell on social media. And that wasn't all. The closely watched ISM Services Sector Index fell into contraction, compounding all of these negatives in the growing negative picture. With the economy now appearing to stumble badly and in these key areas, especially jobs, of course, Treasury yields are moving lower, with new recent lows registering in the middle and long end of the yield curve. And as I pointed out yesterday, while there's near euphoric re-risking in stocks, the fundamental measures like swap spreads never really budged from their April deflation lows. The big one, though, as I said, jobs and especially services. ADP's data show exactly what we've been expecting after the artificial high to last year. So here comes the payback, which has its measure of employment right on the cusp of a negative number in May. In fact, the last time ADP was this low, it had been the same month of the banking crisis back in 2023. So with the bad jobs number plus ISM services flashing a rare recession signal, especially with a huge hit to orders, this is the critical moment for the economy. That's why President Trump was lashing out angrily at Fed Chair Powell, actually saying on Truth Social that it's too late, meaning the Fed waited too long to cut rates again. So here we have an example of a presidential reaction to weakness by reacting to the lack of reaction from the Federal Reserve. Any way you slice it, it ends up with an economy that's increasingly in trouble, and more people can see it, up to including politicians. And even Jay Powell can see it too. He's just more fixated on expectations theory of inflation, when in reality, any increase in consumer prices, as we've seen all around the global economy, leads to exactly what the data has been showing. And remember, this is for the month of May, both the ISM and ADP. The stock market has already rebounded. It's soared ahead. At the same time, we have tariff delays and possible trade deals. And it didn't matter. The economic data has gotten worse because this isn't really about tariffs and trade wars. So what ADP reported was an increase in private payrolls, according to their measures, of just 37,000. That was way below expectations, which were accelerating to an increase of 110,000. And that was down from a downward revised just 60,000 in April. So here you have April and May with barely 100,000 increase in private payrolls between the two of them. Again, I'll point this out again. This is for May. After the stock market rebound, after the tariff delays, all the positive news, at least that's incorporated into stock prices, this is not really about trade wars. It's about a weak economy that barely skirted having worse last summer, ironically because of tariffs and the artificial highs and distortions that were produced at the end of last year. And so what ADP showed is that there were job losses on net in every single size category except for what they define as mid-size, those firms with employees between 50 and 249. What that indicates is that these job losses and the difficulties in the labor market were indeed widespread. At the very least, there's not a whole lot of hiring going on, which of course we know, and maybe even some uptick in layoff activity. As far as individual industries, ADP shows net losses of 17,000 in professional business services, which is a key important cyclical signal that we've talked about many times before, plus also job losses on net in education and healthcare services, which are traditionally sort of cyclical recession proof, which means that the economy really might be stumbling badly if we see more job losses accumulate in especially education and health services. There are also small losses in the goods economy in both manufacturing and mining that were balanced out by continued construction activity, a lot of that having to do with government projects. But either way, you add it all together and you've got an economy, according to ADP, with a labor market that's running barely above positive in a way that we haven't seen since 2020, because this is not just about May or April and May. It's been coming this entire time, really since the middle of last year. That's what we're going to see in the ISM too. The economy weakened with the global inflection that I pointed out last March and April. It came close to the traditional recession last summer, and then a whole bunch of artificial distortions to end last year. We see that in private payrolls like ADP's data, where it increased to the end of 2024, but then contrary to expectations, contrary to Jay Powell's assertion of strong and resilient, everything began to roll over up to and including the job market and payroll estimates. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store of value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. The weakness in ADP is, of course, confounded mainstream economists. As was reported, hiring decelerated to the slowest pace in 2 years as sectors including business services, education, and health shed jobs, pointing to a weakened demand for workers. Private sector payrolls increased by 37,000 last month, according to ADP research, which was lower than all the estimates in a Bloomberg survey of economists. And it marked the second month in a row when figures were well below expectations. This is not a one-month random fluctuation. And of course, as I mentioned on social media, Trump reiterated that Federal Reserve Chair Jay Powell should lower interest rates following the ADP report. Last week, the president had called Powell to the White House and pressed him to cut rates. Because rate cuts are a reaction to the weakness that we're seeing in all this economic data, and the president pressing the Fed chair to lower rates is also a reaction because he's not getting the reaction that he would like. We'll talk a little bit more about what Trump is really trying to do here. But either way, all of it adds up to, from the labor market perspective, this critical week where we're getting lots of updates on jobs and employment, it did not start out well at all. And then ADP was, in many ways, overshadowed by the ISM Services Index, which fell below 50. Before we get to services, though, we already saw weakness in the ISM Manufacturing, and even before that with the ISM Chicago Business Barometer. But with the ISM Manufacturing, that was supposed to increase from 48.7 in April. Expectations were for it to rise to 49.5, but instead it dropped 0.2 more and further indicated the payback after the artificial high last year. That's really that's the dominant trend in the economy right now, is the payback after the artificial distortions. That's what's weakening especially the labor market, but also the services sector industries, as we'll see here, but also manufacturing, which was supposed to be experiencing a renaissance and a turnaround. As it is turning out, as the evidence is showing, it wasn't a renaissance, it wasn't a recovery, it was just the artificial high. And that means we're getting into the thick of payback, which is why we see all of these negative indications showing up all over the economy. ISM Chicago Business Barometer, which is often taken as a proxy for especially the automobile industries because of the location in the Midwest Chicago, that one was also supposed to rise to 45 from 44.6 in April. Instead, it fell more than 4 points back to 40.5, which is, again, consistent with all the artificiality surrounding the car business. Americans bought a ton of cars, especially in March and April, before they thought prices were going to go up, meaning that there was a lot of production and imports and shipping and transportation and inventories leading up to those months as businesses prepared for the entire tariff shock and distortion. But now we've got the weakness showing up in services. And since services make up the majority of the U.S. economy, this is a pretty substantial stumble, especially when you put it together with ADP showed net job losses in these key services industries. It's not a good start to a week where we're focusing on labor market. What ISM reported was their services PMI at 49.9. Now, anything below 53, as I've been pointing out the last couple of years, anything below 53, you're already in trouble. You're into downturn territory. Below 50 puts you in rare companies, I'll get to in just a second. The ISM had ticked up to 51.6 in April, but that was a short-run fluctuation. As you can see, the trend was down from the artificial high last year to begin with. And it had been sinking toward traditional recession, or what everybody recognizes as a recession, last year after the global inflection around April. The ISM Services PMI fell below 50 twice last year, in April and again in June. Before then, it shot up to a high of 55.8 by October. There was some positive sentiment around the Fed's rate cuts, especially the 50 basis point cut in September. The incoming administration, which promised to be business friendly, plus the tariff distortions and a whole bunch of others. The ISM services sector was looking pretty good in last fall, but even starting in November, it was already beginning to roll over, and it's been downhill ever since then, finally dropping below 50 here in May. Again, I'll point this out. That's after the tariff delays, that's during the stock market rebound, but yet here the ISM is in rare recession territory below 50. How rare is it? Well, between January 2010 and the end of 2019, so the decades of the 2010s, the entire silent depression, the ISM Services PMI was under 50 0 times, not a single once. And in between March of 2003 and January 2008, during the middle 2000s expansion, the ISM Services PMI was less than 50 exactly 0 times. So when the economy is expanding, this goes before the 2001 dot-com recession too. When the economy is expanding, you don't see the ISM services below 50. You rarely see it below 53, but you do not see it below 50. And here we have, over the last 13 months, 3 indications below 50, indicating just how serious the economic weakness has gotten to be, not just in the goods sector, which is experiencing an inventory-led recession since 2022, but here more recently, over the last 13 months, in U.S. services. In fact, you look at the history, the ISM Services PMI didn't go below 50 until January 2008, which was the second month of the official declared NBER recession. It didn't go below 50 in the cycle before the dot-com recession until April 2001, also the second month of the recession. So, like I said, ISM below 50 is a rare recession-consistent signal that tells you that there is serious weakness in the services economy, therefore, the overall situation, which is one reason why we get all of these negative indications in things like ADP. These are the same 13 months, by the way, when central banks started cutting rates. They went from higher for longer, we're never going to have low rates again, to, oh crap, we better start cutting faster. And while everybody thought that was just weakness outside the US, as I've mentioned here, the ISM Services PMI 3 times below 50 during those same 15 months. The US economy is not immune. People's perception of the economy has been shaped by Jay Powell on the one hand, which is one reason why President Trump is doing what he's doing, but also the stock market. As long as the stock market is moving higher, everybody thinks everything must be fine. When the data shows that the U.S. economy, globally synchronized, headed into trouble last year with everywhere else, only to then turn around at the last possible minute, not because of a recovery or because it was strong and resilient, but because of a bunch of artificial factors that are now wearing off. We've got the payback, we got the other side of the artificiality, we got the fragile economy that was in trouble in 2024, the same one that convinced the Fed it better get with the rest of the global central banking cabal and start lowering interest rates. As bad as the headline was for ISM services, the new orders index was even worse. Now, anything less than 55 for ISM services that's the danger zone for new orders. It had been as high as 59.4 last September after last year's fall off into the global inflection, the 59.4 representing the high from the artificial trend last year. But then it began to fall off again late into the year, early 2025. By April, it was back down to 52.3. But then from 52.3 in April, it crashed to 46.4 in May. Again, despite the stock market rebound and the tariff delays. How bad is 46.4? That's the worst since December 2022 and the second lowest since the middle of 2020. So the service sector, by all these accounts, growing trouble there. Even the business activity index, it dropped 3.7 points here in May to just 50. Well, 50 doesn't sound bad. Again, this is the services PMI, but business activity at 50 within the services PMI is the weakest level in 5 years. A couple of reasons why this is happening to the services part of the economy. Well, the first part is price squeezes on consumers. Prices that are going to go up for non-discretionary items. Consumers have said they're cutting back. We've seen that in the rising personal savings rate. Where are they going to be cutting back? Well, if you can't cut back on necessities because the prices are rising there, you have to cut your discretionary spending, which tends to be services. So services is the other side of that. And then service sector businesses, they're getting squeezed in their own margins because input costs are going up too. So their input costs are going up that they can't pass along to their customers without provoking a volume backlash, which means that service sector economic participants, service sector firms and companies are really taking the brunt of this fragile economy and the tariff shock. But as we've seen in Europe, service providers in Europe tried to raise prices because of the rising input costs. And what happened? Volumes fell off. That's what we're getting here in the U.S. services sector industries as well. They're trying to raise prices as much as they can, but finding it very difficult to do so. And when they do, business falls off, orders just disappear. So with that economic backdrop, not surprising then, Treasury yields are leaking lower. The 2-year Treasury as of this morning before I started recording was at 386, 387. And if that holds, that will be the lowest for the important 2-year spot on the curve since May 7th. And it's been rolling back lower ever since the middle of last month, along with a whole lot of indications, including what I talked about yesterday with the Swiss franc getting stronger. All of these risk aversion, flight to safety numbers that began to flash more and more warnings in the second half of May. And now we're seeing why that's the case. As I said in the video not long ago, watch the twos. And what did the twos do? While the long end of the yield curve was selling off, at least, the fluctuation over the short run, the 2-year hung in there right around 4% all month. That's where the fundamentals were. The 10-year as of this morning was at 4.36% and maybe moving lower. And that's its lowest since May 7th as well. As Treasury yields at the long end are going lower, the curve flattening out a little bit, the long end starting to reflect some of the same fundamentals as the short end, we're not going to hear any more talk of bad auctions and Treasuries not having enough buyers and all the crap that flows out whenever Treasuries have a short-term fluctuation like they did in May or back in December. As I said in that prior video, it's the 2-year where the fundamentals get priced because this is the bull steepening case. Historically, that's where the money is. If fundamentals do become as bad as they seem to be in all of these economic data, then the 2-year is going to go down a lot more than the long end, which means any uncertainty that happens in these short run periods, you sell the long end and hold the twos. So watch the twos, not necessarily ignore the long end, but realize what the long end is actually signaling, which is almost never what the mainstream says about it. It wasn't about bad debts or bad auctions or too many treasuries. It was simply the steepening case, bull steepening, and a higher degree of uncertainty until we see the fundamentals that are priced in the twos start to become more and more confirmed, which is what we got in economic data today. And because of that, the president lashed out once again at Jay Powell, who he thinks and who he believes is behind the curve. And the reason he believes that is because he sees the economy weakening far more than is appreciated in most places around, certainly the financial media, but also the New York Stock Exchange. As CNBC reported today, President Trump on Wednesday angrily urged Federal Reserve Chairman Jay Powell to cut interest rates, minutes after the payroll firm ADP reported its lowest private sector jobs number in years. Quote, ADP number out. Too late. Powell must now lower the rate, Trump wrote on Truth Social. He is unbelievable, the president said of the central bank chairman, whom he has frequently pressured to shave borrowing rates in hopes of spurring economic growth. Europe has lowered 9 times, Trump added, again, because he knows the economy is in rough shape. So what he's doing is getting ahead of that weakness by putting the noose around Jay Powell's neck. If the economy does worsen along the lines of what the recent economic data suggests, and in the way that the swap market and the Swiss franc and the yield curve are all projecting, then what he's doing is saying Jay Powell's to blame for all of this. He is definitely setting Jay Powell up for the fall should the economic weakness get a lot worse by the time we get to fall this year. So even the president knows the economy is in danger. Otherwise, there's no reason to lash out like this. But when you have confirmation from all the macroeconomic data that continues to come in weaker and weaker and weaker, it makes perfect sense especially since that's what the Federal Reserve's job really is, to be a lightning rod for criticism. Not a central bank. It's not an economic management tool. It's a place to manage criticism for times like these. So we have ADP in the month of May that dropped to near zero. It shouldn't have been a surprise, but it is because everybody keeps following Jay Powell, who is talking about a solid economy and labor market, which is already a downgrade from the strong and resilient labor market he talked about for years. And then ADP today was followed up by ISM Services, which may be the bigger warning because 53 and below is trouble for the economy given the importance of services. And less than 50 for ISM Services is rare. It's almost always recession rare. And we should seriously consider the last year as such, since we've seen forget how to grow all around the world, suddenly remember how to do worse ever since last March and April when these below 50 numbers started to show up in ISM Services, now being matched here in May, despite the rebound in stocks as well as tariff delays. Rates are edging lower again, second half of last month and the start of this month. Risk aversion rising, spreads are deeply negative, and the macroeconomic data continues to align with all of it. It's not about trade wars. Tariffs didn't break the economy, therefore tariff delays aren't going to fix it. We had forgot how to grow, which produced a lot of consternation and a lot of deeply troubling economic signals last year. Now we're just picking up where we left off. And all of today's data also aligns with consumer spending figures, which have suggested consumers in the United States are already pulling back. And I went over those details in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.